Good morning. It is Friday, February 5, I believe, and I am about to lecture in Accounting 230 on Chapter 7, Cost of Goods Sold and Inventory Issues. And without any students here, I will start right up, okay? So give me a moment to try to call up the sheet I need, which surprisingly is the PowerPoint. Let me do this and see if I can share. Hey, who's everybody liking the Super Bowl? I think the Bucks are going to beat the Kansas City Chiefs. I really do. Hi, Brianna.
Hi.
How we doing there?
Good, and you?
All right. Hold on one second here. All right. Are you going to show your mug today, Brianna, or no? Brianna's muted. There we go. How you doing? No sun today? You're muted.
My kids fell asleep in the car, so I have to go back and forth. And
Oh, Jesus, keep an eye on them, huh? My goodness.
Yeah.
Okay, Chapter 7. I was just starting by myself. You know, in my other class, sometimes nobody shows up. So I wait 5 minutes and then I get going, okay? How do you think you're doing with Chapter 6 and the requirements there?
I don't know. I'm getting overwhelmed by so much information.
It sure is. It sure is. But it's not a matter of memorizing. It's a matter of understanding.
Well, yes, and I want to. It's just a lot of.
Yeah.
I think I get
So anyway, like I said, Chapter 6 is a tricky chapter in some ways. This one looks now. Look at this. I pulled up the wrong chapter. Excuse me. Oh boy. Okay. I have to go back. Sorry about that. Hold on. This is what I want. Okay. All right, let me share. Share. Chapter 7. Can you see Chapter 7 now?
Yes, I can.
I actually had it. I just clicked on the wrong icon. All right, Chapter 7, we're continuing with our income statement. We are in Chapter 6. We should be pretty clear that we start with gross sales, which is the amount that came off of our cash register tapes, and our credit card reports. We know we are going to have people return things to us. We know people are going to take advantage of the trade discount, the 2% net 10, and people use credit cards all the time. So when those things occur, we subtract those from the gross sales to get net sales. And net sales, oddly enough, is 100%. So net sales are 100%, and we'll talk about that in a moment, okay? Cost of goods sold and inventory. Items included in the inventory. Don't worry about the manufacturer piece here. That's accounting 240, okay? You purchase merchandise and you sell it. You buy it and you sell it. When you sell it, that's when you have an expense called cost of goods sold. We bought a garment for $1,000. We sold it for $3,000. So our profit on that, or sale rather, is $3,000. The cost of goods sold is the $1,000 we paid for it, and the profit is the $2,000. Okay. Costing of inventory. Now here we're getting into buying our stock. The cost principle requires that inventory be recorded at the price paid. Pretty obvious. It's going to be at the historical cost. So we bought something. We bought something for $10,000. That was the invoice price. But the guy who sold it to us said, "I'm not paying for the freight. That's up to you." So the $1,000 we had to pay the truck driver, that becomes part of the inventory. Okay. And maybe when these goods came in, we had to inspect them one by one. Those inspection costs are part of the asset. And the same thing with preparation costs. If we had to knock down a wall or something like that to get the material in. And so we're going to talk about this a little bit. We're going to talk about LIFO. Let me stay in the order that I like. FIFO, LIFO, weighted average, specific identification. I'm going to be bouncing back and forth, Brianna, between this PowerPoint and an Excel spreadsheet and see if we can get this straightened out here, huh? So let's start with FIFO. And that's me in the picture here. I took that picture about 28 years ago. First in, first out is just what it means. You are telling the world that you are selling the first item you got. In other words, the oldest item is sold first, okay? You bought 10 items on January 1st, and you bought 20 items on January 3rd. You now have 30 items. If you sold 15, you say you sold 10 from the first purchase and then 5 out of that second purchase. Now, when I say you sold the first item, I don't mean you physically did that. None of these costing methods, except one, have anything to do with the actual movements of the goods. So first in, first out is just a mechanism companies can choose to come up with their inventory value and cost of sales. And they will choose one for tax reasons or another for presentation reasons or necessity. First in, first out. Last in, first out. LIFO, last in, first out. We're assuming here we're always selling the newest stuff first. In fact, you never sell the very first item you received, as long as you don't go down to zero anytime. And again, of course, this does not mimic the actual movement of the goods. You know, I live up by Mesa Produce here on Cliff Drive. I happen to know that they use LIFO method. And theoretically, that means they never sold the first bunch of bananas they put up there 50 years ago. Now, do you think that first bunch of bananas is still there waiting to be sold? I don't think so. But they're allowed to pretend that, because this is just a method of costing inventory and cost of goods sold according to GAAP choices that you're given. Not going to worry about that yet. I'm not sure if I want to look at this, but we'll take a peek now. I'm going to skip that, and I think you're going to see why. Let's just take a peek at this here. First in, first out. Well, if you're using that, you're coming up close to what the real prices are in the world. If you're doing last in, first out, the cost of goods sold is probably going to be more conservative, and weighted average smooths things out. I don't particularly like that screen there, but it's there, so let's take a look at it, okay? Now here is something you're gonna need to know for the test. You have 4 different inventory methods, Brianna. That means if 4 companies chose a different one, their net incomes are going to be different. Some methods going to give you a higher income, and others are going to give you a lower. So some companies might say, I want to report big earnings. So they'll pick the method that gives them a higher income. Others say, well, I don't care about that. I want to pay the least amount of taxes. And LIFO would do that for them, okay? And this is just something called the LIFO conformity rule. We don't really look at that much in this chapter. Someday, maybe take Barbara Aue's wonderful tax class, which is really an amazingly good class. We're not going to worry about international. Valuing at lower of cost or market. Cost or market. When you purchase something for your store, and that's what we are in this chat, in this course, we're like Nordstrom's. You bought something for $100, okay? And you've been selling them for $200 and $220, and then the item kind of goes out of style and the prices go down to $150, $130, $110, and you might have 1,000 of these left in your inventory, and you paid $100 each. And now your salespeople are coming back, and they're telling you, hey, they're saying, Brianna, we can't sell these things for $100 anymore. No one's paying 100. This is an out of style sweatshirt. It's got an ex-murderer on the front. You know, no one's going to buy these shirts anymore. Well, that creates a situation where you have to look at the principle called lower of cost or market. And what that is simply, and I mean simply, if you have a shirt for which you paid $100 and the market value is now, say, 60, you have to recognize a loss on that difference of what you paid for it, the 100, and what it's worth now, okay? You will take that loss. And here's a simple example of it. Here's a company that has Pentium chips and disk drives, a computer installer or something, okay? Let's look at the Pentium chips. They purchased 1,000, right? And they paid $260, okay? Now the end of the month has come, or the end of the year, whatever, and you learn that these Pentium chips are only worth $200. That's the market value. The replacement cost is the market value. You used to sell these $260 items for $500. But you know how the computer business is, the turnover is rapid, the technology keeps getting better and better. So no one now is going to pay you $260. Your salespeople say the best you could get is $200. $200. So that's a difference of $60,000, right? 1,000 times 260 is 260,000. You with me on that, Brianna?
Yeah, it says 250, not 260.
Say what?
It says 250, not 260.
Okay, I'll take your word for it. Thank you. 250. Yeah, so they're going to lose $50 for every item. So you have to take 50 times 1,000, and your inventory level is going to go down from 50 to 200. And this is the journal entry, okay? Debit cost of goods sold, credit inventory.
So is this like a monthly thing, a yearly thing, like a journal?
Well, every time you prepare financial statements, yeah, you do it every month.
Every month, okay.
Yeah, you're supposed to. Now, when you get deeper into this, depending on the company, a lot of times you can do this in the aggregate. In other words, you have Pentium chips. Well, you might have some that are still worth something, others that are not. If there's a lot of them there, you can kind of do an aggregate average, if you will. But for our purposes here, we're looking at every single item, okay?
Mm-hmm.
Lower of cost or market. That's the conservative principle. We have 100 disk drives and we paid 100 for it. So I guess that's $40,000. We're selling them now for 110. So do we have to adjust for that, Brianna?
No.
No, because we picked the lower of cost or market. I'm so sorry. Lower of cost or market. Cost is lower, so there's nothing to be done. And that's a quick look, okay?
So the replacement cost isn't like if you're going to purchase a new one.
Exactly. You couldn't have said it any better. Yes. Yep.
So you're not, a company couldn't just come up with what they're worth now. It's like what you would have to pay to buy a new one.
Absolutely. Absolutely. Because everything on your balance sheet must be at the historical cost.
Yeah.
You can't write up the value of your inventory, okay?
Right.
You can't say, wow, I bought 1,000 coats here and we paid $20 a coat. And now we're selling them for $50. Well, you can't record that gain on 50 if you haven't sold the coat, right?
Right.
It's different if the price is going down. Conservatism says you must take a shot. We're not going to worry about the LIFO liquidation. And guess what? We're done with this. But I have a lot more to present, okay? I have more to present. So let's look at something that I put together. I myself. Can you see the spreadsheet?
Yes.
Okay. That chapter, that set of PowerPoints is so inadequate. Maybe I'm looking at the wrong PowerPoints. Maybe there's something better up there and I'm missing something. But it hardly said anything about the 4 methods of costing, right?
There
And
was a few exercises, but kind of help explain it, but
not too much here. Now, here's what I'm going to do. I'm going to try to make you guys experts in the 4 costing methods, okay? So let's look at the situation here. We have 4 methods, as you know. FIFO, what does FIFO stand for?
first in, first out.
And LIFO?
Last in, first out.
Yep, and then we have one called average costing and one called specific ID, okay? So let's go through this exercise a little bit. I really would like you guys, everybody else who's looking at this later, you're watching the Super Bowl and you're looking at this at the same time, I bet, huh? Okay, look what we have here. We have a beginning inventory of 400, and then we purchase 200 more, 300 more, 600 more. That adds up to 1,500, okay? Let's call that the total available for sale. Why do we call that the total available for sale, Brianna?
Because it's a total available for sale.
Right. You can't sell any more than you have, right? Yeah, it sounds funny. It's an easy concept, but boy, the students get so mixed up on that at first anyway. So it looks like you know what I'm talking about. You had 400 books in your bookstore to begin. Then you bought 200 from this publisher, 300 from this guy, and 600 here. That means the most you could have sold is 1,500, okay? Here are the prices, 2, 3, 4, 5. Prices are going up, okay? Now, in your book, everybody, they talk a little bit about what you do when prices are going down. You are not going to get any questions on that situation, which is called deflation. We are optimists here at Santa Barbara City College. We are glass half filled people. No economy can exist under long deflation. Inflation is desirable. You need some inflation. So that's how economies grow. So the rules we're going to be talking about are for inflation only, okay? So the prices are going up. You multiply them across, add down. Not so tough so far, right, Brianna?
Right.
Notice that the information is the same. Notice that the total available units for sale are the same regardless of the method, right? And that makes sense because these methods are done at month end using what happened during the month, okay? And that's an important thing to understand. The cost of goods available for sale is going to be given to you. You might have to figure it out a little bit in terms of how they put the numbers, present the numbers to you. But the beginning inventory plus the subsequent purchases represents the total available for sale. Where the thinking comes in now is we now have to come up with the cost of goods sold and the ending inventory. Because in this chapter, they talk about how the beginning inventory plus your purchases minus the ending inventory equals the cost of goods sold, okay? So we have 1,500 units available. I'm telling you that we had 300 left. We had 300 left. So that means we sold 1,200, okay? So let's have a little bit of fun here. Let's figure out the cost of goods sold using FIFO, okay? Using FIFO. So my question to you is, Brianna,
Yes.
under FIFO, we sold the first in, first out, right?
Correct.
So we sold 1,200. Where did we get those 1,200 from?
Beginning, the first, the second, and half of the third.
Let's see, 4 and 2, that's 6. That is correct. 4, 2, did I write that? Yeah, 4, 2, 3,
300.
300, right?
Mm-hmm.
You agree? I do too.
Yes.
Pretty good. So that's a good start understanding that, right?
Mm-hmm.
Okay, so we could, over here, we could identify it, right? Like this if we want. There we go. And what were the prices?
2, 3, 4, 5.
There you go. 2, 3, 4, 5. Okay. 2, 3, 4, 5. We'll get rid of that 0. Now, what are we going to do with this information? What's going to go here? You'll multiply it out, right?
All right. Yeah.
We're going to multiply them out. And now we're going to add them down, and that's going to give us what? Will give us a number. That number is 4,100. What does that represent?
The amount sold, the cost of the goods sold.
Exactly. That's the cost of goods sold. Cost of goods sold. Okay? FIFO. FIFO. Let's do this. Let's go through all 4 methods, just worrying about the cost, and then we'll go back to the inventory. Okay, Brianna?
Okay.
Okay. Here you're starting with the same information, right?
Yeah.
But now we're using LIFO. So we sold 1,200. Where did we get those 1,200? Which one did we sell first?
The third purchase.
Yeah, we sold 600, right?
3, 2, and 1. 300, 200, and 100.
Oh my goodness, I can't escape this. 600, and you said 300?
200, and then 100.
Pretty perfect, huh? 600 was the third purchase, right?
Yes.
Remember I told you when I was working, there were certain jobs I kind of liked to do. This one I always kind of got a kick out of doing for some reason. And we had to go back to the beginning inventory, huh? I'm glad you went back to the beginning inventory. A lot of students miss that. They think everything starts with the first purchase. Okay. So what are the prices here? 5432, right? You agree with that?
Yes.
Eh.
Why did you take those numbers?
What's that? Well, this thing didn't copy the formula. I wanted it to copy the formula. Okay.
Oh, the formula. Okay.
Yeah. Okay, I have to do it this way, I guess. This is stupid. I should have been able to just copy the formula from the left and get the right answer. Okay, here we go. 3,000, right? And this is going to change if there's a God inside of heaven. Oh, okay. What do you notice about the cost of goods sold between the two?
It's higher.
Higher, yeah, higher. Remember that one grid we just looked at in the PowerPoints? It said some managers want to, some businessmen want their company to show the highest profit possible.
For bonuses.
Well, yeah, there could be. You're exactly right. I haven't thought about that. Yeah, but there could be selfish reasons for that. Okay, but let's put that aside. The reason we kind of are saying in our book here is they want to present to the public the best possible net income they can, and they're even willing to pay extra taxes to do that. In other words, a company wants to make a big splash, so they say we're going to use FIFO. That's going to minimize our cost of goods sold so that when we go to the public, we're going to show a profit of $10 million. Okay. Instead of 9 million, which would be roughly the difference, in this case. Okay. So let's do cost of goods sold for the other methods. Believe it or not, Brianna, you just did the two hardest methods. Okay.
Mhm.
Let's do average cost. Under the average cost method, we're going to just come up with that average cost, and then we're going to multiply it by the sales. We're going to multiply it by the ending inventory, and we're done. The question is, how do we get this average cost? The key thing to remember, Brianna, it's all on the available line.
Yeah. Just divide
Plus
those.
5,600 divided by 1,500. That's our average cost. Okay. Don't make this mistake. Go ahead. Question.
Oh, no. Just
Don't
thinking
make
out
the
loud.
mistake students make. They say average cost. Oh, I'm going to get the average of these four people here. No, if you do that, you're going to come up with a number of 3.5. You're going to be wrong. Okay. You seem confused.
Nope, I got it.
Yeah. The only time this would work is if all the units were the same, So
Right.
this is the correct average price because you got the weight in there.
Mhm.
So what do we do here? Well, we do the cost of goods sold first, I guess, huh? Cost. Oh, I have it down here already. I'm sorry. Got so much room, huh? Cost of goods sold. Okay. How many did we sell, Brianna?
1,200.
What was the average cost?
3.73.
Yeah, let's see if it at least picks this up to copy. Okay. Let's see if this works. Come here, you come on. Kids okay in the car?
Yes. Got all the doors open and all the wood. So
Yeah,
they're
you're out in the
just-
fresh air.
yes.
Okay, so what's your cost of goods sold under this method?
T less.
44.80, right?
Mm-hmm.
Average.
What were the ones up for the other ones? Sorry, I'm looking at the wrong numbers.
We're looking at average costing.
Average. What is it compared to the FIFO and LIFO?
Oh, I'm sorry.
Okay, so it's in the middle.
LIFO 4,100, the lowest. FIFO will give you the lowest cost of sales
Always, yeah.
and the highest inventory on hand, thus the higher income, okay? LIFO will always give you the highest cost of goods sold and the lowest reportable net income. So this company here, the FIFO company, they pick FIFO because they want to show whammo. Our profit hit over, we'll pretend that's the profit number. They're saying, wow, our profit broke $4 billion for the first time. Okay, big splash. Hopefully people start buying their stock, pay more attention to their product.
Mm-hmm.
These guys said, well, I just want to minimize my tax burden. So they go for the cost of goods sold here, and they're going to have a difference in profit of $900. Would you agree?
Yes.
900 times 0.3 is 27, right? So this company here, they saved, depending on the size of the company, 270,000 in taxes or 270 million. You know what I mean?
Yes.
Okay. Average cost. Specific ID. I made this one easy for a reason. The one thing I don't like in our book about
I'll be right back, Professor.
okay, just let me know. We're taking a break, but I will continue because I know you are still with me. You wouldn't dare walk away from this class. We don't want that. Okay, I'm going to share this back again, everybody. Just hold on here. Okay, if you've been with me, I'm going to continue till Brianna gets back, and then we'll jump back and bring her up to snuff. We have gone through 3 costing methods: LIFO, FIFO, and average costing. LIFO, FIFO, average costing. And what you learned here is that the cost of goods sold under FIFO is going to be less than the cost of goods sold under LIFO. Another way to say that is the cost of goods, the profit under FIFO will be more than the profit you would report if you were using LIFO. And like I said, let's pretend that's a $900 million difference, assuming a 30% tax rate. That company saved, what, $27 million worth of, $270 million in taxes. They thought that was better than making the big splash, okay?
All right, I'm back. Sorry.
Okay, I was just going back with the rest of the class on the FIFO and LIFO a little bit. So we'll continue, Brianna, thank you. So average cost, right?
Yeah.
That's how we got the cost of sales, average cost. Let's get the cost of sales here now under specific ID, okay? Specific ID, everybody, is the one method that does match the physical movement of the goods. With specific ID, we're talking expensive, big ticket items. When I bought my car, when I bought my Lamborghini about a year ago, I walked into the lot and he had a whole bunch of them out there. And I said, yep, I'm gonna buy one of these right now. So I gave the guy the money. He didn't then say to me, okay, Bob, those are the Lamborghinis in the parking lot. Go out and pick the one you want and drive off. Doesn't work that way under specific ID. An auto dealer must know who bought what specific car. They have to know what car it was, what color, the make, the serial numbers, the VIN numbers, the engine specifics. So specific ID is the representation of the movement of the inventory. And in a way, it makes it an easy method because they're telling you where the goods came from. So what am I saying here? Let's take a peek. Sales came from the beginning inventory, huh? And the first and third purchase. The reason I picked those out is they add up exactly to 1,200, okay? So what did we do here? We picked up 400, 400, Jesus Christ. From the beginning inventory, 200, and the third purchase, 600, okay? So this is the beginning inventory. This is the first purchase, okay? And this is the third purchase. Not too tough, huh? So you have beginning inventory, that was 4, 2, 3, and then 5. And then we do our arithmetic. And I'm determined to make these cells work. Well, I guess they would work, do the same thing. Okay. Not introducing anything. Okay, come on. You got the Friday blues here. Okay, there we go. All right. And that adds up to?
The bottom should be 3,000, the third purchase.
2 times 3 is 6. How did that end up like that? Yeah, this thing is a little quirky for some reason, not copying the formulas quite right. Okay. That's what we want to see, right, Brianna? So take a look at what we have here. We have just computed the cost of goods sold for our 4 methods. FIFO, first in, first out. LIFO, last in, first out. The easy one, the average costing. And another easy one, the specific ID. Now, when you're doing your homework, unless the book is changed, they make the specific ID problem extra hard by the way they present it verbally. Instead of something simple, like I just gave you here, the problem in the book might say something like, the 1,500 or 1,200 units were sold. 1/3 of the sales came from 2/5 of the first inventory and 3/5 of the third purchase. You get the idea? It can make it very confusing. I don't know why they do that. This is not a semantics course. Okay. So Brianna, I'll call on Brianna here today. You feel a little bit comfortable how to prepare these schedules, at least for the cost of goods sold?
Yes.
Not too bad, huh? Well, we also have to come up with now the cost of the inventory. Okay? The cost of the inventory.
The lower margin thing?
No, this has nothing to do with lower cost of market at this point. Nothing to do with cost of lower market. But we have 300 units left in the inventory, don't we?
Yes.
So let's
So that-
put those down. Let's put them down right here, huh? We know we have 300 left in the inventory. Come here, you. How do we get that cost?
It's from the third purchase at 5 per unit.
Yeah, how come?
That's what's left over from taking the first out.
Exactly, exactly right. Exactly right. So our ending inventory is 1,500, okay? How do we tell if that number is right? And don't tell me by remultiplying. What were the goods available for sale under FIFO? You see that, Brianna?
Yeah, I can't see the number. Oh, I see it down there.
5,600, right?
Yeah.
How much did we have on hand at the end of the month in dollars? 1,500, right?
Yeah, and the cost of it was 4,100.
That's how you get the cost of goods sold.
Yeah.
Total available for sale minus the ending inventory equals the cost of goods sold.
Yeah.
So once you get the cost of goods sold, all you have to do is subtract it from the available to get the inventory. And guess what? It works the same way opposite. If you subtract the cost of goods sold from the available, you get the inventory. If you subtract the ending from the goods available, you get the cost of goods sold, okay? Confusion on that, Brianna?
Nope, I got it.
I think that's fairly clear. So let's do our LIFO. Again, we have 300 units left. What's the price of those 300 units?
2.
Pardon me?
2.
2. Yeah, you seem to have a pretty good grip on this. 2. 2, because this was LIFO. That means we got rid of these 600, 900 now. We got rid of that. That's 11. We had to take 100 out of that, away from that tranche, and there we go. Total available for sales, 5,600. Subtract the ending inventory, and you get the cost of goods sold, okay? The available number at the end of the month has either been sold or you still have it. To the extent it's not there, we assume you sold it. Now, I imagine it would be a shock to this company if they counted 300 and they never sold anything. Then they got a problem. What happened to 900 items? Okay, let's continue with specific ID. Well, let's read what it said. The ending inventory was, we sold 400 and then 200 there. I guess the only one we didn't touch was the second purchase, huh?
Oh, we're on specific ID. Yeah. Mm-hmm. Sorry.
Yep. And the price of that is 4. Okay, 3 times 4 is 12. Take a look again. Cost of goods available. Cost of goods available, 5,600 minus 1,200 gives you 4,400. Okay. Now you ready for the tough one?
Yeah.
Ending inventory. How many do we have in the ending inventory?
300.
What's the average cost? Do you remember that number?
3.73.
Mm-hmm. What we do is multiply this out. And take a look. Available for sale, minus 300 times the average cost minus equals 1,200 times the average cost. So that one's really easy. Wouldn't you think so, Brianna?
Yes, I think so.
Yeah, you just do these a couple times. I mean, I happen to kind of like this chapter. What I don't like were those PowerPoints. I wonder if I pulled a truncated version of them. Okay.
Maybe doing the equations that, like comparing FIFO and LIFO a lot.
Say that again.
Like if you have, in the chapter, it said comparing two companies that use two different methods and then changing them so that you can compare them. Are we going to be doing much of that?
Yes, yes. Some of the questions on the test are going to be LIFO, FIFO. And again, we're only talking inflation. We're only talking a normal economy that grows. An economy can't grow without prices going up, hopefully just a little bit under control. You don't want to work for the same amount of money your whole life. You expect to get more and more money and blah, blah, blah. So you're going to get questions on FIFO, true or false. LIFO will give you the lowest net income, true or false.
True, LIFO.
Yeah, LIFO, and that's because the cost of goods sold is higher. Yeah, you'll get questions like that. Okay, Cornelia and I guess every teacher, I guess, automatically throws this question down: true or false? The physical movement of the goods must match the accounting method. True or false?
Was, I don't know
Want
if I
me,
understand.
want me to say that again?
Yeah, so the actual movement.
The physical actual movement of the units
Oh, false?
must equal what you're doing here. No, of course it's false. Of course it's false. Okay. Yeah. Look at this one here. LIFO. This is the Mesa Food Market.
Right.
And this company's been in business for 70 years. According to this, they have never sold $300 worth of grapes they bought during World War II. You know, we know that's foolish and silly, but that's the emphasis we want to put on the fact that these things are not tied to the physical movement. Okay.
So the book kind of says that, you know, you have to stay consistent.
Oh, yes.
Picking one, but the last sentence, it's, as I understood it, kind of sounded like, well, you can change it if it benefits. And it's like, well, then you wouldn't, I don't know.
No, you just can't change it month to month. No. If you're going to change your inventory method, there's a whole complicated process for doing that. Okay. And if you do, from my memory, and I know some of the other professors might know better, if you change your method, you may have to go back and restate prior months of activity.
Okay.
You certainly can't choose LIFO this month, or right. LIFO the next, depending on how things went. There has to be that consistency. Absolutely.
And on like systems like QuickBooks or Sage or what all these other ones, do you choose one of those, or is it kind of done behind?
What do you mean choose what?
Like when you have inventory in a system like QuickBooks or one of those other ones, do you pick which method?
Oh, I'm sure. Yeah. I worked with QuickBooks for about 5 years, but that was 20 years ago when I was CFO at the Santa Barbara neighborhood clinics, and we did not have inventory, you know. But yeah, you'll go into QuickBooks, and I hope you take the QuickBooks class here with Carol and Terry.
Yep.
Yeah, you'll go into QuickBooks, and as you get set up, it's going to ask you what your inventory method is, I'm sure, and you'll have these choices here. Okay. Now, let me give you all another tip. We went to a lot of trouble getting the cost of goods first, right, Brianna?
Yeah.
We went 4 times 2, and then we went 2 times 3, and 3 times 4, and 3, and then we added up, and we got this number, and then we came back. My point, I bet you know where I'm going with this. If you get a problem where the inventory is a very low number like this, just do the inventory,
Right.
right? We could have done this problem in 2 seconds. Let's see, the ending inventory is 300. We got 600 there, so that must mean we have 300 left. 300 times 5 is 15. 56 minus 15 is 41. We're done.
Yeah.
Just a tip, right? Now, when I was making up my tests in my class, I tried to avoid that happening, except maybe on one problem, just to see if anybody picked up on it, okay? So here we go. Let's see what else we have, what other goodies we might have here, okay? How about a little more lower of cost or market type stuff? Okay, hold on here. Okay, this is just something let's see. Oh, I think I built this one time during a lecture. Somebody thought it would look a little more clear this way. But you can see FIFO, cost of goods sold, 170. Under LIFO, cost of goods sold is, well, I don't like that at all. Oh, okay, this is not what we're talking about here. But it is part of the chapter. Let's take a look here real quick. No, that's not going to help us, not right now. Could you hang in there one more moment, Brianna? I just want to see one more thing here.
Of course.
I just want to look at one more. I'm going to look at a different PowerPoint here. Look at this. This is the one I should have pulled up, okay?
Oh, okay.
So let's do this. Let's do this. We'll go through this PowerPoint with some alacrity, and then we'll get everybody home early for dinner, okay? Although you're probably already home. Okay, here is a different set of PowerPoints from the same publisher, okay? And they're talking about learning objectives, blah, 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 blah. Income statement. Okay, Brianna, pay attention here. What we're saying now in your income statement, you're going to have gross sales minus the sales returns and allowances, minus the sales discounts, and minus credit card charges to give you what is called net sales. And net sales represents 100%, and every number below it is a percentage of the net sales. So let's take a peek here. We have net sales of 5,567 and 14. Cost of goods sold, 3,542, gross profit. Sales minus cost of goods sold equals gross profit. And now we're adding inventories into our balance sheet, okay? And we talked about this, freight in would become part of it, okay? Most company report inventory costs, invoice price, less return, we kind of know that. I'm not gonna worry about this. What is this trying to tell us? Well, we have available for sale 95. And if we have an ending inventory of 35, that means the cost of goods sold was 60. We have goods available for 95. If the purchases were 55, we have that much there. They're just trying to get you to understand the cost of goods available, okay? calculating cost of goods sold. So let's take a look at this. This is important. Beginning inventory plus purchases gives us, guess what? Cost of goods available for sale minus the ending inventory. That's exactly what we worked on. And they're talking two different systems here, perpetual, periodic. We'll get to perpetual later. We're teaching right now what's called the periodic method, which means we don't have a daily up-to-date record of the inventory through the month or year. When we sell something, we're debiting cash or accounts receivable and crediting sales, but we're not doing the other part that we're learning now, which is to debit cost of goods sold and credit inventory. So we're talking periodic in this chapter. And here we go. The four methods again. Let's see how it's presented here, okay? So let's start with what they gave us here. Specific IED. Cost flow assumption. Boy, they took the wind out of my sails with that, Brianna. I thought we were going to see the calculation. Okay, well, here we go. It's jumping around a little bit, but some students like to see a physical presentation. And this is a good look, huh? This is a good look. Well, let's see what we have here. We had 2 in the beginning inventory, right? Then we bought 4 more at 80. And then we had another one we bought for 100. So under FIFO, which ones did we sell? We sold the 2 old ones, right? And 2 of these 80s. What did we have left in the inventory? We had the 80. We had the 80, and the 100. 160, yeah. Oh, there's 260. I got you this time, Brianna. Okay. First in, first out. They're giving us the information. And remember, the cost of goods available is the same, no matter what the method is. And of course it's the same. It's your history. It's your starting point, if you will, at the end of the month. So they're telling you here, these guys sold 4 units, huh? They had 7 available and they sold 4. Here is the calculation. Ending inventory. They had 7 and they sold, well, in this, what I hate here, look at, they're jumping around, right? First in, first out, they sold available. Yeah, available 7. Do you notice this thing is totally wrong when you look at it, right? They
7.
sold 2 units and they had 2 left in the inventory.
Oh.
But
Well,
they had 7 available. Now I bet I know why somebody buried this.
I think it was 3 and 4.
What's that?
7. I think it was 3 and 4 equals 7. Ending
Yes.
is
At the you have 7 available, right?
yeah. Ending you have 3 left and use cost of was 4, so it's 7.
No. It's saying that you sold 2.
No, and 2. 2 at 70 and 2 at 80.
2. Oh, thank God. Oh, geez. Man, oh man. My peripheral vision is not what it once was, Brianna. You know, I used to play
Okay.
basketball. I could see the whole court. I could, give the ball off. Thank you. I'm so glad you saw that. Okay, so that works.
Yeah.
Here's LIFO. What did we sell first? LIFO, we sold the new stuff first. 100, 80, 80, 80. We have 180 left over. 270s, okay? First in, first out. This time I'm going to read the whole thing. LIFO. 2 units and 1 unit, 3 units. There we go. That adds up to 7, thank goodness. And there's the calculation. There is the calculation from this grid over here. Last in. Average cost method, super easy, right? You get the average cost. You're going to divide 560 by 7. The average cost is going to be 80. 80. All you do is say you sold 4 times 80 and you have 3 times 80 left. That's the easy one. Okay. Perpetual system. Beep, 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 beep. Let's not worry about that. Now here's a look at a real summarized income statement for the 3 methods. So this would be good for students to have in front of them studying for the test, because the questions are going to be, which one is going to give you the highest income? Which one's going to give you the lowest? Well, as long as you see that FIFO gives you the higher income compared to LIFO, you just need to know that. One of the questions on the test could be along the lines is, why does LIFO reduce your income, Brianna? Why does LIFO reduce your income? Tell me.
The cost of goods are more, so you're deducting more from your income?
Exactly right. The cost of goods is higher because you're saying that the item we just sold cost $80 and we're still holding on to the one we bought a year ago that we bought for $30. Yeah, exactly right. LIFO. Any conflict between the 2 motives is resolved by choosing one accountant for external and a different method for preparing tax returns. I am not going to get into this. This is not my milieu, but some managers prefer to report higher earnings. Others want to pay the least amount of taxes. If last in, first out is used for income taxes, it also has to be done for the financial statements, okay? The LIFO conformity rule. Oh man, you must be sick of lower cost of market, huh? Lower of cost of market. It's the conservatism principle. It represents a little bit of a departure from the cost principle. LCM is important for 2 types of companies. High-tech companies, I guess, and seasonal goods, okay? If you're selling fruit and the fruit's getting less and less tasty as the cooler weather comes, maybe you can't sell it anymore. Net realizable value. That's just what the market is telling us. That's another way of saying to calculate the market. When the net realizable value falls below cost, we have to reduce that inventory, huh? And it's a holding loss. We used to debit an account called cost of goods sold dash LCM, lower of cost of market. And that's what you're seeing here, right? This is the similar to what we had before, okay? Lower of cost of market, inventory turnover. I'm just going to talk about this briefly. Next week, I'm going to give you your first FSA assignment. And you're going to look at 2 companies, General Mills and Kellogg's, 2 cereal companies. And you're going to have to do some write-ups on them and do some statistical calculations, including this one. Let's look at it. I think this is interesting for all of you out there in television land. The cost of goods sold divided by the average inventory gives us a turnover, okay? This ratio reflects how many times the average inventory was produced and sold during the period. A higher ratio indicates that the goods move more quickly, thus reducing a lot of ancillary costs, right? You have less storage cost, obsolescence. Goods are always at their freshest. So let's see what the calculation is. They're not giving us numbers, okay? Not yet, anyway. I just want to see something. Okay. I think this would look better with numbers. Okay. So they came up with a turnover, right? A turnover of 10. Making that up, right, Brianna? Turnover of 10. You talk to your boss at the end of the month, like I said, for the AR, and you say, hey, boss, we turned the inventory over 10 times. And the boss could be an engineer. She could be a sales executive background and not know what you're talking about. And she says, what does that mean? and you say, oh, it means the number of times we produced and sold the average inventory, and a higher ratio indicates that inventory moves more quickly. If you spoke like that, they'd throw you out of the room. We're going to turn it into days, right? 365 days in a year. You're turning over your goods, 365 divided by 10 in my example. So you are selling your product 36 and a half days from the time it arrives at your store till the customer walks out with it. Okay. Oh, we're not going to go over the FIFO reserve. Cash flows. I don't think we're interested in that. LIFO. Yeah, I think we're good here. All right. I'm glad we found the second one here. I think that's enough for one day, huh? What do you think, Brianna?
Yeah, sounds good.
You got your money's worth today?
Yes, I think it's all good. I mean, the whole in the book it said, sorry, I just had to get like converting the income statement to FIFO. Like you have the LIFO reserve, so that's not something that's a big thing we need to.
I don't think so, and I'll double check with Cornelia.
Okay.
No. Other
All
than knowing that you can convert it is the issue in this class, I think. Anything dealing in this course, anything dealing with payroll or taxes, we typically set aside because those are taught in great detail in the payroll and the tax class.
Okay.
Any other questions?
No, that's it. Thank you so much.
All right.
Wait, the exam is next week?
Pardon me?
We only have chapter 8 and then there's an exam, right?
Yes, now we're really rolling through this class. Absolutely. So chapter 6, I think is the trickiest one, just in the area of the AR, of the bad debt world. This is pretty cut and dried, Brianna.
Mm-hmm.
This I think is a little bit easier. And then the next chapter is about depreciation methods.
Okay.
So I guess we have class on Tuesday and Friday. And your exam, I'm sure, is over the weekend, next weekend, right?
I'm not sure. I didn't look.
Pretty sure it is. My point being, Tuesday we'll do chapter 8, and then Friday I'll have a test review for everybody, okay?
All right. Thank you so much. Have a good weekend.
Hey, you too. Bye-bye, Brianna.
Bye.
Goodbye to all of you who've checked in and seen this video. And by the way, you hear it right now. The Tampa Bay Bucks are going to beat the Kansas City Chiefs Sunday, and they're going to do it fairly easily. Remember where you heard it. Talk to you later.